Welcome to my YouTube channel Knowledge is Wisdom. I am Salman Zulfikar. Today we are going to discuss risk. What is the risk? What are its types? What is financial risk and its type? So let's start with the definition of the risk. Risk is an event which may occur, which may not occur, and if it will occur, then you will have to face its consequences. I repeat this definition. It is an event. It may be a positive event, it may be a negative event, it may be a good event, it may be a bad event. We will discuss it later on. It may occur, it may not occur. There is possibility, there is not 100% surety that it will definitely occur or it will definitely not occur. There is probability. It might be occur, it might not be occur, and if it will occur, then you will have to face its consequences. Suppose a person is driving a car. There is a possibility that the brake of the car may got fail. God forbid, there might be a case of accident, there might be a case of theft, robbery, any engine heat up issues, technical, mechanical fault, anything can be happen. So these all are the risks when you are driving a car. So risks are available, risks are in each factor and each event of your life. If you are doing a business, there are different types of the risk. Suppose if you are running a business concern, then what would be the risk? The risk can be the losing the money, risk of losing your investment, risk of losing your capital. The suppliers may deceive you, the creditors may not pay back your money, the interest rate may high, the inflation may rise up, the prices of raw material and other things may rise. So there are so many things. The liquidity crunch, you are not able to pay back your short-term debts. So there are so many risks which are available in the business concern. So to elaborate these concepts, we will go to the board to understand these things with the help of the examples. So we were talking about the risk factor. A good business concern, good company always develop a risk team, always develop a risk management department, and the duties of risk management team is to, first of all, what they do is, first of all, they prepare a list that what would be the risks that we can face in our businesses. They prepare a list. It may be a 10 risks, 20 risks, 30 risks, whatever. It depends upon nature of the business, and it may vary from business to business. Each business has different risks comparatively to the other business. So business risk management team, first of all, will prepare a list of the risks. Suppose we are manufacturing oil, and we are importing the raw material from any other country like Malaysia or any other country. So there are different types of risk. While during transit the raw material by the ship, there might be a case of a flood, there might be a case of fire or anything. There might be possible the supplier will not provide you the material which you demanded. Might be possible your creditors will not pay you back money. So the risk development team will prepare the list of the risks. So the risk element is always certain. You know that which part and where you will get and what risk will you get, you will have to face. It is always certain. The parameters are known. Parameters which evaluate the risk, the intensity of the risk, they are known. Parameters means criteria to measure. Criteria to measure, like GDP is a criteria to measure the economic growth of any country. So likewise, there are different parameters which measures the risk of a company or risk of a firm. First of all, the risk development team will prepare a list. Then they will give rating to each risk. In rating, they will judge the two main things. That one, first of all, what would be the intensity of the risk, that if it will happen, then what the loss we will face. And secondly, what is the frequency of that risk, if it will occur occasionally or it will occur number of times in our business concern. So in the base of these two things, they will rate each risk, and after giving rate to the risk, they will develop a good strategy to minimize the risk. So it is always certain, the parameters are known, you know what are the parameters, what are the strategies uh, for which you adopting, you will reduce or minimize your risk. There are two types of the risk, one is downward risk, one is upward risk. Downward risk means the risk which comes from any bad event. Bad event means political uncertainty, the inflation, the interest rate high, exchange rate may vary as dollar rate is varying, so these all are the bad events. Upward risk, the risk which comes from not availing any opportunity. Suppose you have an opportunity and you have not availed that opportunity, so the risk which you will have to face by not availing that opportunity, that will be from upward risk. Suppose in a mobile phone company is working on 4G technology, and its competitor is doing research on 5G technology, and they introduce the 5G technology, and they will capture your market. So there was an opportunity. This company can also make research on 4G, on 5G, but it didn't avail that opportunity. The other company availed that opportunity, that's why it captured its market. So this is the risk which comes from the upward side. So these are the risk: operational risk, financial risk, interest rate risk, liquidity risk. These all are the risks which a business concern has to face. Now if we will specifically talk about the financial risk, what is the financial risk? First of all, we will have to know, we will have to study that what is the finance or financial activities. If we look into the definition of the finance, finance is basically science of knowledge which deals with three A's. First of all, first A is acquiring finance, second A is allocation of funds, and third A is asset management. So there are three A's. Finance is I repeat the definition: finance is a body of knowledge which deals with three A's to deal to in an efficient way, which deals with three A's in an efficient way to achieve the goal of the company or on any organization. So this is the definition of the finance. So all the risks which are related with the definition of finance, three A's: allocation of fund, acquiring finance, and asset management. So the risks which are related with allocation of fund, acquiring finance, and asset management, they are under the financial risk. They are known as financial risks. There are three main types of the financial risk. First of all, market risk. Second one is credit risk. Third one is financing or liquidity risk. The market risk consists on equity risk, interest rate risk, exchange rate risk, commodity. These all are the risks which are associated with the market, and they are almost beyond the control of the organization. Equity prices of the share may go down or up. Interest rate of the banks by the State Bank of Pakistan may go up or go down. The interest rate of the banks may go high, and you want to acquire a loan from banks, and the interest rates are going to high. The exchange rate risk, the exchange rate of dollar or any other currency may go change. The commodity prices, due to inflation, the material prices, the raw material prices, or any other prices may go variate, and due to variation in the prices of the raw material, the price of your commodity, the sale price of your commodity may go high, and due to high prices the demand may go low. So the credit risks includes customer risk, creditor risk, partner risk, to whom you sold goods on credit. Customers, they may deceive you, the creditors may deceive you, the partners may deceive you. They are not, they might be insolvent or any other issue. There is any other fraudulent activity, deceiving activity, or any other activity, any other problem may be happen. So now the last one is financing. or liquidity means the investment activities. As I already told you the definition of the finance, it relates with the pure financing activities, investment activities, oblique liquidity activities. Liquidity means to pay back your short, the ability to pay back your short term debt is called, is known as liquidity. As we are familiar with the different ratios, current asset over current liabilities ratio, current liquidity ratios. Financing, you have invested money in any business, in any property, in anything, and and you got loss from there. This is financing risk. Market liquidity, you are not able to pay back your short term debts. Cash flow problem, you have invested in a business, you have purchased the raw material and converted into the finished goods, and now it's not selling out in the market, so the cash flow would go to negative side. So these all are the risks which are under the umbrella of financial risks. So we try to discover and to learn the risk, definition of the risk, types of the risk, and financial risk, and I hope that you would be better able to understand the concept of the risk. Thank you so much. Goodbye.